Hello everyone. Welcome to first class of our stock market trading. So let me introduce myself. My name is Amit Kumar Singh. I am SEBI registered research analyst and investment advisor. So I will teach you stock market courses. So primarily talking about what all we are going to discuss in this class. We'll try to understand the basic regulatory body which govern the stock market. So first we'll talk about the regulatory body and their roles and responsibilities. Okay, so we'll talk about that. Okay, we'll try to understand what is the need of the stock market, why we need to have a stock market in our country. We'll try to understand that part. So primarily, why we can correlate the movement in the stock market with the economic development. We're gonna understand the need of stock market. We're gonna understand the need of stock market, why we need to have a stock market with us. Okay, what change the stock market will bring in our life. We'll try to understand. And primarily, I believe that since you all are attending this class, so the first thing what comes in your mind, or the first thing what anyone will ask you when you want to do trading in the market, is to have a demat account. Okay, so first thing first, you need to have a demat account in order to do anything in the stock market. So we'll try to understand what is demat account. So what is the concept of a dematerialization? Okay, we'll try to understand the concept of dematerialization. Dematerialization, what do you mean by dematerialization? What is rematerialization? Why you need to have a demat account? We'll try to understand that part. Okay, and gradually we'll try to take some historical instances of what has happened in the past and how we can see the development of the market from a commodity market to an equity market. We'll try to cover the historical landscape of the development of the stock market. So we'll discuss these things in this present class. So I hope this class will be informative and you will get to know a lot about market. Okay, so talking about stock market, why we need to have a stock market. Primarily, I believe you must have heard of New York Stock Exchange, or you would have heard of American Stock Exchange. Okay, MX. Okay, this is MX, American Stock Exchange. Or in India, we have Bombay Stock Exchange and we have National Stock Exchange. Like there's another stock exchange for commodity market is NCDX. Okay, then we have MCX, Multi Commodity Exchange. So they are like a lot of stock exchanges are there around the world. Like I gave you a few example of stock exchange in US, like New York Stock Exchange or American Stock Exchange, or you can say Dow Jones. Okay, Dow Jones is there. Okay, then in France you have CAC. In Germany you have DAX. Okay, in England you have FTSE. Okay, in Japan you have Nikkei. Okay, so then in China you have Shanghai Stock Exchange, you have Singapore Stock Exchange. Like this, there are a lot of stock exchanges are there around the world. So what basically happens in the stock market? So what basically happens in the stock market is like people trade. What they do? They trade in the market. They trade means what? Trading means like if you go to the stock market, what you basically do? Okay, you trade. Okay, what do you trade? Okay, on what you trade? Like, do you trade on books or do you trade on pen, pencil? What you trade? So basically, we trade on securities. Okay, what we do? We trade on securities. We call them securities, or we call them shares. Okay, or we call them stocks. So when it comes to stock exchanges, okay, when it comes to stock exchanges, when I talk about stock exchange, so stock exchange, when I say stock exchange, the stock exchange is primarily the market where the trading of securities happens. It's primarily the market where the trading of securities happens. Okay, people buy and sell shares. Okay, the people buy and sell shares of a company. Okay, like I'll give you the example. Like for tomorrow, what I can suggest, like okay, just don't consider this as an like real example. I'm just giving you one dummy example. Like for tomorrow, you can consider buying Tata Motors because automobile sector is gonna boom because the Reserve Bank of India has reduced the repo rate by 25 basis point, and recently in the budget the government of India has given the tax relief till 12 lakh rupees of income. So all that will what all these measures what they will do, they'll bring liquidity in the market. So when they bring liquidity in the market, so what will happen? So probably the people will have more money to spend. So when people will have more money to spend, then definitely they may go for banking sector to go for loan, okay, or for financing of the fund if they don't have the fund, okay, because the interest rate, if the Reserve Bank of India reduces the repo rate, automatically the interest rate in the market will become less. So probably those who would be wondering or those who would be thinking to buy some assets or they would be planning to do some home loan or anything or car loan, so they will get more motivated to do those so because the interest in the market is actually getting reduced. When it will reduce, then automatically it will motivate people to spend more. So when people will spend more, they will either spend on real estate or they'll spend on automobile sectors. Okay, so you can say that now going days forward, you can see very good movement in the market when it comes to infrastructure sector, real estate sector, or you can say automobile sector or metal sector, because the spending power of the people is getting increased. Now it's getting more stronger. So what is repo rate and how central banks like Reserve Bank of India do these changes and all, we'll discuss it later on. But primarily right now, understand that the stock exchanges, like in India, we have two stock exchange. One is Bombay Stock Exchange and another one is National Stock Exchange. So basically, under these stock exchanges, what we do, we trade. Okay, we trade shares. Okay, we trade shares or securities of the companies. Okay, so when we trade, so like it's a human logic. No, when you trade means trading means what? Trading means buying and selling. So trading means buying and selling. Trading means buying and selling. So what you will buy? What you will buy? Tell me what you will buy. You will buy those securities which you expect that they will go up in the future. Okay, means you are optimistic on them. The other word of optimism is bullishness. So if you are bullish on any securities, you will primarily will buy those securities. While if you are bearish on any securities, okay, or you are negative or pessimistic on the security, you will think to sell them. So stock exchanges is basically the platform where you'll find many companies shares are trading. Okay, you in when it comes to NSE, you have like around 2,900 securities with whom you can trade, over whom you can trade. If you go to BSE, you have 4,000 securities, okay, over whom you can trade. Okay, so you can trade on these securities, you can buy or you can sell them. So we'll buy those shares which we believe that they will go up in the future, and we'll sell those shares which we believe that they can fall in the future. So whichever shares we have a expectation that they will go, we'll try to buy them, and whichever we have negative or pessimism about them, we'll try to sell them. So every day, what happens when the market opens? Every day, sorry, every day, what happens when your market open? You can see actually which stocks are going up or which stocks are going down. So there's a website called portal.tradebrains.in. You can go to this website. Okay, and once the market get open, so our market opens when I talk about Indian market. So Indian market opens at 9 a.m. So, but the real trade starts from 9:15. So from 9 a.m. to 9:15, you have pre-market hours. So what is pre-market hours? I'll explain it later on. But for the time being, you understand that the actual trading happens. The actual trading happens after 9:15. So from 9:15 to from 9:15 to 3:30 you can trade in the market. Okay, so from 9:15 to 3:30, what you can do, guys, you can trade in the market, and you can and if you go to this website called portal.tradebrains.in, you can actually see those stocks which are doing movement. Okay, so you can go and search those stocks which are giving movement, either positive movement or either negative movement. So positive movement stocks, they will show in green color, and those stocks which are falling down, that they will show in red color. So every day what you can do, post 9:15 or get ready by 9:15, that you can see these stocks which are giving movement. Okay, and then you can decide which stocks can you buy, which stocks you can sell, how to choose those stocks and all. I will explain you. Okay, don't worry about that part. You remember this website called portal.tradebrain.in. If you go to this website, you can see the those stocks which are giving movement. Okay, so what are sectors and all? What is Nifty 50, Nifty Next 50, Nifty IT? All this I'll explain you. Okay, but primarily, if you want to check which stocks are giving movement, if you want to see them, you can go to this website and you can see those stocks which are giving movement. So once you have a Demat account with you, so once you have, there are many platforms are there. There are many platforms or depository participants are there, under whom you can open a Demat account. And once you have a Demat account, you will get a platform over which you can trade in the market once you refill your account with certain money, and then you can use them for the trading purpose. So stock exchange is primarily the market where we do tradings of the securities. So when we talk about the Indian market, our market opens at 9 a.m. Okay, and it closes at 3:30 p.m. Okay, remember this timing. This is the timing for the trading on equity market. So if you trade on equity market, you will you will remember the time for the trading. While from 9 a.m. To 9:15 a.m. Okay, 9 a.m. to 9:15 a.m. you have pre-market hour. I'll explain you what is pre-market hour. So during pre-market hour, we cannot trade in the market, but we can observe the market. Okay, the real trading start from 9:15. Okay, so I hope this much everyone would have understood. So when it comes to the trading in the market, we have a Demat account, and then we see the movement. Okay, which stocks are giving movement, and based on that, we'll see which stocks we can trade in the market and all. So there are few people who are intraday trader. So there are many people who are intraday trader. Intraday trader only find out those stocks which can show good movement today. Okay, so intraday trader have time from 9:15 a.m. to 3:15 a.m. Okay, to trade over the market, because after 3:50 a.m., 3:15 a.m., your broker will square off your contract if you have done intraday trading. Normally, when you trade in the market, you have a two option. Either you can trade intraday. Intraday, the advantage what you get in intraday is like you will get around 5x leverage. 5x leverage basically means you just need to make 20% of the payment. Okay, and the brokerage is little bit higher as compared to the normal trade, but the intraday trade is like, it's like a scenario where you are taking position on those stocks which are doing or which are showing very good movement today. Maybe or may not be they'll do good movement tomorrow, but we are not bothered about tomorrow movement, or we are not bothered about yesterday movement. We are bothered about which are the stocks which can show good movement today. We'll pick those stocks and we'll take position on those stocks. The advantage of trading in intraday is that you don't have to pay 100% of the contract value. You just need to pay 20% of the contract value. So imagine there's a share X, and the price of share X is suppose 25 rupees. And suppose you have you have decided to buy 50 shares of this company. Okay, so the actual price, so the total cost, if you do normal trading in the market, that would be 25 into 50. Okay, but If you are doing intraday trade, you don't have to pay this 100% of money. You just need to pay 20% of this money. So the 20% of this money would be 250 rupees. Okay, so that is the advantage what you're getting. So you can leverage, you are getting a leverage of 5x. 5x means you just need to pay 20% of the money. Okay, so it will not happen every day. Some like budget or some important days, sometime brokers or our exchange don't allow us to do intraday trade. Then they'll say you have to do delivery trade. Delivery trade means you have to pay 100% of money and you have to hold the share till the time you want, but you have to hold beyond a day. Okay, the proper buying will happen. That proper buying is the delivery trade. Intraday trade is like you're simply speculating on those shares which you believe that they are gonna show good movement today. You're least bothered about what will happen tomorrow. And the advantage for that is that you just need to pay 20% of the money. So many people get into the intraday trade in reality, because through intraday trade they have to pay less amount of money. And next advantage while doing intraday trade is that you can buy the share, you can buy and sell by 315. Okay, you can buy the shares which you think they are good movement, and you can sell it by 315. If you don't sell, your broker will sell. Or what you can do, you can even sell now within the market hour and buy it later. Buy it later by 3:15 p.m. So those stocks which are giving a negative movement means those stocks which are falling. Actually, if the market opened and you saw certain stocks which are showing negative movement, like NBCC or Gujarat Gas Limited or Colgate Palmolive, suddenly you realize that these stocks are negative. So what you can do, why will you buy the share? You can buy Colgate Palmolive if you are looking for long term. If you think that Colgate Palmolive is a very good company, but it is falling down because of some reasons, like Tata Motors has actually fallen down a lot. Okay, and now it's trading around 700 to 800 rupees. And earlier it was beyond 1200, 1300. Now it has actually fallen down. So if you buy now, so buy on low, buy on dip and sell on high. If you can buy now and you can hold the share for maybe 1 year or 6 months, that is a good decision. But many people, what they are thinking, they are seeing some shares falling down and they can see there's a more scope of the share to fall more. Okay, they think that there's a more scope, that there's a more possibility that the share can fall more. So what they can do, they sell it. Okay, that they can sell it and they can buy it later on. So when you square off your position after selling means you are buying only. So that is called as short selling. But the short selling is only for intraday trade. Okay, it's not possible for delivery trade. So when you are trading in the market, you can do intraday trade, okay, or you can do delivery trade. In delivery trade, you cannot sell it. You cannot sell it now and buy it later on. Okay, delivery trade, that is not possible. Only in intraday you can do that. So I hope you have understood this. So many people, when they trade in the market, they do intraday trading. Okay, they do intraday trading, and then the other way, what you can do delivery trade. When you do delivery trade is the trade where you pay 100% of money, where you can only buy, and you pay 100% of money. You pay 100% of the fund. Whatever is the cost required, you pay 100% of the cost. Okay, and you get the actual delivery of the share. Here you will get the actual delivery of the share. Here you will get the actual delivery of the share. You become the true owner of the company. Okay. So once you do delivery trade, so you'll get the proof of the trade. You'll get the proof of trade. Okay, with in a written document which we called as a contract note. So you'll get the proof of trade through a written document, what we called as a contract note. And this contract note, by the end of the day, your broker will mail you through depositories. You'll get this contract note either from NSDL or you'll get this contract note from CDSL. Okay, these are NSDL and CDSL are basically your depositories. They are basically your depositories. Okay, the full form of NSDL is National Securities Depository Limited, National Securities Depository Limited. The full form of NSDL is National Securities Depository Limited, and CDSL full form is Central Depository Services Limited. Central Depositories Services Limited. Okay. So basically, when it comes to delivery trade, when you do delivery trade is the actual trade what you perform in the market. So when we do trading on the delivery, when we are doing trade on the delivery here, you will get the actual delivery of the shares, and this is for long term purpose. Okay, and here you have to pay 100% of the cost, and here you can only buy, you cannot sell it. Okay, and then the proof of the trade, because you have done the buying, so the proof of the trade you will get from your broker. Okay, you will get from your broker, and that you will get by the end of the day. That will be called as a contract note. Okay, so once you go for delivery trade, under the delivery trade, what you can do, many people go for swing trading. Swing trading basically means that if you hold the share for 1 week to 1 month, okay, that is called swing trading. Okay, so this is called aggressive swing trading. Some people go for defensive swing trading, where if you hold it beyond 1 month to 3 month, that is called swing trading. Or you can do positional trading. Positional trading basically means that if you hold the shares beyond 3 month, 3 month to 6 month, okay, that is called positional trade. Okay, or you can go for investment. Investment means more than a year. Investment means if you hold the share, more than a year, then that is called as investment. So when you are trading in the market, if you are going for delivery trade are considered to be less risky. It's like everyone should participate in the market. You should take position in the market. Market looks very volatile. Sometimes the market goes up, sometimes the market goes down. If you are trading in options and all, that might be little bit risky. But if you are trading in the actual market, it's spot trading. If you do delivery trade, if you do go for swing trade or positional trade, then the risk factor is comparatively less. You can buy the share, and the share will be yours, means you will get the ownership of the company. Whenever you are buying the share, means you are getting the ownership of the company. Tomorrow, if the company declare dividend, you will get the dividend. If the company announce bonus issue or right issue or any corporate actions, in the whatever the company will do, you will get all the benefits. Okay, being the actual buyer of the company share. So that is the advantage of delivery trade. So if the company will conduct any meeting, they will tell you before only that we are conducting this extraordinary general meeting or something, because when you are buying share on a delivery, means you are becoming the actual owner of the company. You are becoming the actual owner of the company. So although that may be fractionally very less percentage, but even then you become the owner of the company. That is the advantage you have to understand when you go for a delivery trade. So when it comes to equity market, debt market, what is equity market, what is debt market, I'll explain you. But you can remember this, that whenever we are talking about trading in the market, when you go for delivery trade, which is considered to be less risky, you become the owner of the company, and then you can hold the share depending upon your objective for certain time period. Okay, so we have two stock exchanges, Bombay Stock Exchange and National Stock Exchange, where we can trade, where we can buy and sell shares. And these stock exchanges primarily work between 9 a.m. to 3:30 p.m. Okay, from 9 a.m. to 9:15, AM you have pre-market hour. During pre-market hour, you cannot do any trading activities, but after 9:15 your market will become active, and then you can participate in the market. Okay, so what are options, what are futures, okay, what derivatives and all I'll discuss later on. For the time being, you just understand that we have these two exchanges over where we perform trading, we buy and sell shares. Okay, what is shares? Shares represent the ownership of the company. Okay, so I'll explain you the ownership pattern, equity, debt, the examples, the differences and all. But I believe you have understood this basic idea about this. So whenever you go to the market, or whenever you get into the field of stock market, the first thing what you have to do, that you have to open a demat account. Okay, so what is basically a demat account? Demat basically means dematerialization. Okay, when we say demat, demat basically means dematerialization. So before, what used to happen before, our market was having an open outcry system. The era where when there was no internet. Okay, people used to trade physically over physical securities, and the proof of the trade they used to get in the form of a physical certificate. And that time, forgeries or other activities which are not in aligned with the market used to happen very easily, because we used to follow T+5 settlement. That time we used to follow T+5 settlement. So in T+5 settlement basically means that whatever the trade you used to do today, you used to get the delivery of the trade after 1 week, primarily because we used to have 5 working days. So you can expect that after 1 week you used to get the delivery of the trade, back in the days when we had the era with Harshad Mehta and all. So that time, because this Harshad Mehta scam and other historical instances, the government of India become very scared, because during 1991 we implemented LPG in our country. LPG stand for liberalization, privatization, globalization, and then suddenly an economic boom started happening into our market, and people like Harshad Mehta took advantage of this economic boom, and whatever he has done, I'm not here to justify it. I'm not here to justify it positively or negatively, but like people like Harshad Mehta and Ketan Parekh, they have shown a different perspective of the market to the common middle class people, where middle class people started believing that a stock market would never fall, and believing on that perspective, many people had started putting their money into the market, and this has created a big problem when this scam has came out. So after the Harshad Mehta scam, government of India become very scared, and government of India wanted to come up with a concrete measurement, so that these kind of instances can be avoided in the market. So government of India has created a body called SEBI. So the full form of SEBI is Securities and Exchange Board of India. Securities and Exchange Board of India. The full form of SEBI is Securities and Exchange Board of India. And SEBI is being created through SEBI Act of 1992. So through SEBI Act of 1992, Government of India has created this body called SEBI, and the objective of the SEBI, why the SEBI is created, because SEBI was created to act like a capital market regulator. SEBI was created to act like a capital market regulator in our country. What is capital market? How capital market is different from money market? I'll explain you later on. But for the time being, you'll understand this, that the SEBI was created under SEBI Act of 1992, where SEBI is considered to be capital market regulator, and Government of India has given all powers to the SEBI to decide what best they can do for regulating our market, for making sure that the middle class or common people can trade freely without any problem, or the companies which are using stock market for the funding issue, they can work with the best interest. Okay, they cannot play with the investor money. To keep an eye on all these parameters, Government of India has created this body called SEBI under the SEBI Act of 1992. And even then, SEBI do all regulatory measurement uh, with respect to the how the public company should function, how the investor can trade in the market, how the fin influencer can educate people. But even then, the final power vested with Government of India through SCRA Act. So SCRA Act is there, SCRA Act of 1956, Security Contract Regulatory Act. So SCRA Act give enough power to the Government of India to regulate the stock market around our country. And Government of India, whenever they want, they can change the definition of any instrument, and by that way they can allow them to trade in the market, or they can, if they want to ban, they can ban any financial product for trading in our country. Okay, so Government of India have that power with them. So we have a SEBI, and the work of SEBI is to govern the functionalities of stock exchange in our country. So you can see the regulation of buying, selling, and dealing in securities such as share of a company, a unit of mutual fund, derivative, stock exchange, commodity derivative exchange, and depositories come under the purview of SEBI in term of SEBI Act of 1992 and various SEBI regulation, circular guidelines, okay, or directives. So remember that earlier for commodity market, like normally in India for commodity market, people primarily trade on MCX or NCDX or NSE. So for commodity market, we had another regulatory body called FMC, Forward Market Commission. But now commodity market is also regulated by SEBI. Derivatives market, mutual funds, what are mutual funds, what are derivative market, I'll explain you later on. These products are also comes under a purview of SEBI. Remember this. So SEBI was established on 12 April 1992 in accordance with the provisions of SEBI Act. Okay, the mandate of SEBI is to protect the interest of investor in securities and to promote the development or regulating the stock security market and matter connected with them. So SEBI was formulated to make sure that people like you and me who don't have much knowledge about the market, they can trade freely without any tension in the mind, without any consideration of any kind of fraud with their fund. All that issues can be minimized. I cannot say they can be avoided, but these are minimized because we have a regulatory body called SEBI, which is taking care of everything. Okay, so remember this part. Okay, so when we are talking about stock exchanges, we have a SEBI, and SEBI take care of all these parameters when it comes to our country. So the SEBI Act of 1992 empowers SEBI with powers like protecting the interest of investors who want to trade in the market, to protect their interest of SEBI is there to promote development of stock market and to regulate the stock market. Then we have a Companies Act of 2013, which provide regulation for issuance, allotment, and transfer of securities and related matter in public issues of securities. So what happens, guys, that you have to understand that when any company want to list in the market, okay, so for that they have to do an IPO. You will not like understand that you will not find every company shares in the stock exchange. Like if I ask you, tell me the price of Byju's share, okay, or tell me the price of Amul share, okay, or tell me the price of NSE share, okay, you cannot find. NSE is not trading in the market. Why NSE is not trading in the market? Because NSE is not a public company. You can find only those companies uh, shares in the market which are public company. So what is public company, private company? Uh, with time you'll understand what is public company and private company. But understand that we have a understand that we have a SEBI, and SEBI makes sure that any company which issues fund from the market, and by then they become public company, they work with the best interest of the public. Okay, so I will explain you this part, that what is public company, private company, if you don't know. Okay, so primarily what happens that when a company is looking for fund in the market, and they raise this fund by equity, by making others to be the part of the ownership. Okay, then the company become a public company, and whenever any company want to list themselves on the stock market, then they have to take permission from the SEBI. Okay, and once SEBI gives them a permission, then only they can list themselves on the stock exchanges, and then automatically the ownership pattern of the company changes from private company to a public company. So the for all the activities of corporate actions, the company need to transform themselves from a private company to a public company, and there the role of Companies Act of 2013 comes. Then you have the SCRA Act, which gives power to the government of India to regulate all the activities of the stock market. Then you have Depositories Act of 1996. So what this Depository Act of 1996, basically, like I have given you the story of Harshad Mehta and other scams. So when these scams happened in the market, the government of India was very scared about what they can do to make sure that fraudulent activity can be avoided. So for that, uh, government of India, when they did proper analysis, they decided that nowadays, if you have to trade in the market, because now we have internet and all exchanges are connected through internet. Okay, so better to have a trading in electronic form. Okay, so that whatever the shares people are buying and selling, uh, it need to be done in electronic form, and for that the concept of dematerialization came in picture. The concept of dematerialization came in picture because dematerialization means conversion of physical paper into electronic form. That is called dematerialization. So with the consideration of SEBI and other regulatory body, the government of India has decided that whatever the trading activities would happen henceforth, that need to be done in the electronic form. And then when people would buy and sell in the electronic form, then they need an address, right? They need a place, or they need a space, they need a Google space, or they need a e-space where they can hold the share, right? If you are trading in electronic form, then you need a place, right, where your shares would be there. Means you're trading, you are not doing in physical form. So there should be a space, right? There should be cloud where your shares should be there. So those space, those platform is provided to us by depositories. Okay, so we have depositories, like I've given you the name of the depositories. We have two depositories, NSDL and CDSL. So we have two depositories, NSDL and CDSL. NSDL stands for National Securities Depository Limited, and CDSL stands for Central Depository Services Limited. So these depositories, what they do, they give us the space that whenever we are trading, okay, our shares would be hold there. Okay, our shares will be there under there in depositories. Although when you are trading in the market, you are trading through some broker, maybe Zerodha, Angel One, Carvi, or ICICI Securities, but your shares would be kept in some depositories, like the safe house where your shares are there. They are there in depositories, and these depositories are created by Government of India through Depositories Act of 1996. So Depository Act of 1996, Depositories Act of 1996 has given the initiation of these depositories. Okay, and whenever we buy or sell shares, then the accounting adjustment happen in these depositories, and the proof of the trade, whatever we do, will get in the form of contract note, and this contract note is sent to us by our depositories. Okay, so either NSDL or CDS. Now, going further here, so I hope you have understood the SEBI Act, Companies Act, SCRA Act, Depositories Act. Okay, so what are securities and securities market? So equity share, or commonly known as share, represent the share of a company, a share of a ownership in a company. An investor who invest in share of a company is called shareholder, and it is entitled to receive all corporate benefits like dividend out of the profit of the company. The investor is also entitled to receive the right to cast a vote with regard to decision making process of the company at the general meeting of the company. So before I make you understand the equity and debt, okay, first let me know that have you understood what is stock exchange? First, let me know, have you understood what is stock exchange? Okay, have you understood what are depositories? Okay, have you understood what is intraday trade, what is delivery trade, what is swing trading, positional trading, investment? I hope you have understood these terms. You have understood the roles and responsibilities of SEBI, what is demat account. Okay, so understand that when we are trading in the market, uh, we think that okay, we have a demat account. I have demat account with Fires or Dhan. Okay, they have given me the platform now. Since I have this demat account, they have given me the platform. Okay, what I can do, I can buy or sell whatever I want. I can buy and sell, but in order to buy and sell these whatever securities or instrument, first thing, I need to have a fund to be added in my account. Okay, next thing is that although I am trading, but this platform of trading is given to me by my broker, and all risk management of with respect to the trading is lying with them. Okay, so if any fraudulent activity happen in the market, then my broker would be responsible for any kind of activity with respect to the market, because my broker has given me that platform, or that room my broker has given me. So you have to understand that when you are talking about brokerage houses, what they have done, brokerage houses are registered with stock exchanges. Okay, you have these brokerage houses, what they have, they are registered with these stock exchanges. Okay, and they give us the platform to trade in the market. And when we trade in the market, for that trading, what they do, they charge brokerage fee. Okay, they charge brokerage fee. They charge brokerage fee from us for trading in the market. Okay, if you do intraday trade, your brokerage would be higher than if you do a delivery trade. Remember this. Okay, so the brokers are there. They charge brokerage fee from us because these broker has given us the facility to trade. Okay, to in order for us to enjoy that facility of trade, these brokers have given me that platform of trading in the market. Okay, so understand that understand this part, that why we can trade in the market, because our brokers are registered themselves over the stock exchanges, and they are giving us the facility to trade, and for that they charges from us brokerage. Okay, whenever you trade in the market, you have to pay brokerage. Okay, few would be direct cost of trading, few would be indirect cost. So brokerage and non-trade, some would be trade charges, some would be non-trade charges. You can see STT, other some other indirect taxes would be charged. You can see those brokerage, and same time these brokers are also registered with depositories. Okay, so when these brokers are registered with depositories, then these brokers are called as DP or depository participant, because these brokers are registered with depositories. Okay, what are the depositories? we have depositories, no? We have NSDL, we have CDSL. So these brokers are also registered with depositories, and what they do the work of depositories. Like when you want to trade in the market, first thing first, you need to have a demat account. So who helps you to have a demat account? Your broker helps you. Okay, what they do the KYC. KYC basically means know your customer. Okay, know your client or know your customer, where you have to submit all relevant data, your PAN card, Aadhaar, and photo, last 6 months of your account statement, everything you have to submit to your depository participants or broker. So there they don't charge any money from you, and they do all the paperwork for you so that you can connect with the depositories. Okay, so once you get connected with these depositories, then whenever you trade, your shares or whatever you trading activities you perform, that would be hold under the demat account. Okay, but at the same time, along with the trading account, you along with the demat account, you need to have a trading account. And for the trading account, they are connected with the exchange, and because they are connected with the exchange, so they give you, once you are registered and all, then they'll give you the facility that yeah, now you can trade, and for that trading they'll charge brokerage from you. Okay, so that is the way how the broker works in the market. Okay, so every broker gives you different kind of facilities. Okay, whenever you want to trade in the market, your broker gives you, they provides you different kind of facilities. Okay, the different kinds of platforms they will give you so that you can trade effectively in the market. I hope you have understood all this, okay, so far. So understand that why you can find some company shares, but you cannot find other company like BSE. BSE is a public company. BSE, you can trade. You can see BSE. BSE is a stock exchange, and BSE is a stock exchange, and this stock exchange, what this stock exchange do, it gives you the platform to trade, right? It is a stock exchange, but at the same time, BSE is a company also. It is registered under Companies Act of 2013, and any company can be of two types. A company can be a private company, or a company can be a public company. So BSE is a public company. Why BSE is a public company? Because BSE has done the IPO. Okay, what do you mean by IPO? IPO basically means when you are raising money from the public, that is called an IPO. So BSE has done the IPO. So once their IPO is done, they are registered over the stock exchange. So BSE is registered on Bombay Stock Exchange also, and BSE you'll find on National Stock Exchange also. You can trade the shares of BSE. BSE have the ownership which we call as share, which you can trade. Okay, so primarily what you have to understand, guys, here, that here you have to understand very basic finance. Okay, that finance basically is all about how a company, okay, how a company can raise money from the market. It's not about company. It can be individual or it can be government of India, anyone. So anyone in this world have requirement of fund. So how that fund or the capital is raised. Okay, that capital you can raise by two ways. Either you can raise the capital when you are talking about raising capital. This capital you can raise by two ways. Either you can raise by equity, or you can raise this capital by debt. Okay, there are two ways how you can raise the capital. You can raise the capital by equity, or you can raise the capital by debt. Okay, what is debt? Debt is all about borrowing. When we say debt, debt is all about borrowing. Okay, so a company or a government of India or a individual, when they are looking for a fund, they can borrow money. So when you borrow money with an obligation that you'll pay back in the future. Okay, so whenever a company is looking for the fund, what they can do, they can, instead of doing equity issue, they can do a debt issue. So when the company do a debt issue, what they do, they can borrow money. So whenever a company borrow money, they borrow money for a definite time period. Okay, if it less than 1 year, it's called money market or a short-term debt instrument. When it's more than 1 year, it is called more long-term debt instrument. So company can borrow money. Whenever the company is borrowing money, this is borrowing is done for a fixed time period. This borrowing is done for the fixed fixed time duration. This borrowing is done for the fixed time duration. And remember that in borrowing, ownership is not transferred. Depend that in borrowing, ownership is not transferred. Whenever we say in borrowing, in ownership is not transferred. Whenever a company they borrow money with a commitment that they will pay back in the future. Okay, whenever the company borrows money, they borrows money with the commitment that they will pay back in the future. And in the case of debt, okay, so since in debt ownership is not transferred, the interest is paid. Remember that interest is paid. Okay, no matter uh, it's a compulsory. No matter company get a profit or loss, that thing does not matter. What matters is that if a company has borrowed money in the form of debt, they have to pay interest on the debt, and that is paid after every regular interval of time. Okay, that the company has to do. No matter they are getting a profit or loss, they have to pay the interest. So always remember, debt is a risky instrument. Okay, why the debt is a risky instrument? Because in the case of debt, whenever the company is raising money in the form of debt, they have to pay interest regularly. So the risk what is involved whenever you're borrowing money in the form of debt, that is called financial risk. This risk is called financial risk. This risk is all about that either you're getting a profit or loss, doesn't matter, you have to pay interest. Okay, that we call as debt. Okay, so here debt instrument represent money that is borrowed by the company or institution from the investor, and it must be repaid to the investor. Okay, so the money what is borrowed is called price of the debt instrument, and the money what the company has to pay back, that is called face value of the debt instrument. And in between, the company has to pay interest after every regular interval. Okay, debt instrument, if they are for long term, more than 1 year, if they are secured, then it is called as bond, or if they are unsecured, we'll call that as a debenture. An investor who invest in debt instruments are entitled to receive payment of interest. The other word of interest is coupon. So whenever you buy any debenture or non-convertible debentures, NCD or bond of any company, you are entitled to receive interest from the company. The other word of interest in the world of finance is called as coupon. Okay, so and once the debt instrument get mature, you will get the principal, or that is called face value of the debt instrument. And whenever the debt instrument are issued, they are issued always for a definite time period. Okay, and that can be redeemed by the issuer of the instrument. Some kind of debt instrument have a feature that is called callable bond. Okay, some kind of debt instruments are called as callable bond. Okay, this is little bit advanced concept. If you don't know, also fine. They are called callable bonds. Callable bonds are those bonds which the issuer, means the company which has issued the debt instrument, if they want, they can mature the debt instrument or pay back your face value before it expiring. So that facility, when it if it available in a particular debt instrument where the issuer of the debt instrument redeem, or they will they will pay back your money before the expiry, before the actual year of expiry of the debt instrument. That facility is that facility the issuer get. That facility is called, those kind of debt instruments are called callable bonds. They are something called putable bond. So in putable bond, as an investor, you have that power that you can say the company that, dude, I want my money back. I since see I have given you money for 5 years, and you have committed me that you will give me interest for this 5 year, and after 5 years you will pay back my face value. But dude, I don't want. I have certain other requirement of money. Do one thing, give back my money. Okay, so that is called putable bond, where the investor have the right, but in reality you won't find putable bond much in the market. Whatever bonds, if you find, if they have these kind of feature, it would be always a callable bond. Callable bond become active when the interest rate in the market falls down. Whenever there is a possibility that the interest rate has actually fallen down, okay, then automatically demand of the earlier debt instrument which were being issued at the higher interest rate, their demand would fall down. So whenever the interest rate goes down, the price of the debt instrument goes up. So at under that time, many times the issuer of the debt instrument or the creditor the company who had borrowed the money, they will expire the debt instrument and give back money to the investor before the expiry under the provision of callable bond. So I hope you have understood what do you mean by debt instrument. Okay, I hope you have understood this debt instrument. Talking about equity, so debt you understand in the case of debt, ownership is not transferred. Okay, but when you talk about equity, when you talk about equity, in the case of equity, ownership is transferred. Whenever you talk about equity, in the case of equity, the ownership is transferred. Whenever you talk about equity, the ownership is transferred in the case of equity. So whenever you are talking about equity, in case of equity, the ownership is transferred where a company is actually making others the part of the organization. So whenever you are raising money from equity means you are making other the part of your organization. That way, if you are raising fund from the market, that is called equity issue. Okay, so equity issue basically means that you are looking for a fund, okay, and that fund you are not borrowing. That fund you are giving to others. That fund you're taking from others, and by taking that fund, you are giving your part of your ownership. That is called equity. Okay, I hope you have understood what do you mean by equity. So normally, you have seen many small companies, they go to venture capitalist. Okay, you have seen they go to venture capitalists or they go to seed funders or private equity companies, and from them they raise fund from them by diluting their ownership. Okay, you have seen Shark Tank. Okay, there you come up with your business plan and you pitch your business plan to potential investors who can invest in your organization, and you raise money from them. So these all are our private issue. These all are our private issue, or this is also called as private placement. This is called private issue or private placement. You go to some organization or you go to some potential investor and you give your ownership to them. And by giving your ownership to them, you are raising money from them. That is called equity. So whenever we are seeing equity, in equity, we are making other the part of organization. So an investor who invests in the share of a company is called shareholder. Okay, and the company is called issuer, and you and me, whoever invest in these companies, we are called a shareholder. And whenever you are buying the ownership of the company, okay, you are becoming the owner of the company. So since you are becoming the owner of the company, you are entitled to receive all benefits what the company can give you. So in the case of equity, company don't have a commitment to give you fixed benefit. Like in debt, the company gives you fixed benefit in the form of interest every year, no matter they get a profit or loss. But in the case of equity, whenever the company get the profit, whenever the company get the profit, that is called profit is called PAT. From the part of profit, if the company want, they'll give you some part of profit, which is called a dividend, and remaining part, if they want, they will not give you, or whatever they want, they can give you, or if they don't want, they will not give you also. Okay, so here, if the company want, they will give you the part of profit that is called dividend, and remaining part they can retain with themselves. That we call a retained earning. That we called as retained earning. That we called as retained earning. So retained earning is the part of earning what the company does not give to the shareholder. So the payment of dividend is not the compulsion. If the company want, they will give to the shareholder in the form of dividend. Otherwise, they don't give. Okay, so if the company is looking for fund in the market, if the company is looking for fund in the market, they may raise fund by debt, or they can raise fund by equity. If they're raising fund from debt, in the case of debt, ownership is not transferred. In the case of debt, company is taking the risk that tomorrow, if they're not able to earn beyond the interest, then they will face a very big problem that is called financial risk. and that might affect the long-term viability of the company. But the other way, the company can raise fund from equity. If the company is raising fund from equity means they are making others the part of the organization. So you can buy any company equity, but you have to make sure that you should understand the business model of the company. You should understand if you believe in the company, if you believe that the business model of the company is appropriate, if you that way only you can buy the ownership of the company. So when the company is in initial stage, when the company have the limited scope, they have limited net worth, they have limited asset in the market, and when they look for raising fund by giving their part of organization to certain individuals or certain firm, then they'll go to venture capitalist or seed funder, and they can approach them for the funding. They can approach them for the funding, and from them they can get the required fund. Okay, that is the initial stage when the company do. That is called as private issue. When the company do a private issue means privately they raise money from the market. So when the company do a private issue, the ownership pattern won't change. A private company would still act like a private company only. The ownership pattern won't change. So a company, what is a company? You can read about the company, and you can read about Companies Act of 2013. What is private company? What is public company? You can read about them. Okay, private company, public company, you can read about them. So when you are talking about a company, the private company or a public company. So private companies are those companies uh, who are liable to show their final account to certain set of individuals who are only the owner of the company. So if I am working right now in a private company, so whatever business we do at the end of the day, our balance sheet, profit and loss statement, we are liable to show to our chartered accountant who prepares this thing. We are liable to pay to Government of India. They see all these things, and then GST department. Oh, they can have an idea, or the promoter of the company look into all this thing. Everyone cannot show any interest when it comes to private company, because we are a private organization, so we are liable to private set of individuals. We are liable to Government of India. But what the company can do, a private company, if they are looking for more fund in the market, so what instead of going to debt, what they can do a public issue. They can do a public issue. Public issue basically means that public issue basically means that a company, what they can do, company can go to SEBI. You know what is SEBI? Company can go to a SEBI, and you can request to the SEBI that, sir, we are looking to raise money from the public. Public means more than 50 people. We want to raise worth more than 10 crore rupees, or from more than 50 people from the market. So since we are targeting more than 50 people for the fund issue, okay, so we need to take your permission. The company have to take permission from the CB if they want to do a public issue, and then they come up with their IPO. Then they come up with the IPO. IPO basically means initial public offering. Okay, so what is IPO and all? I'll explain you what is IPO. So company come up with an IPO, and the IPO run for 3 to 10 days. Normally in India, any IPO runs for only for 3 days. IPO basically means public issue, initial public issue, and the market where the company do the IPO, that is called as primary market. So and this market is called as primary market. So in the primary market, the company do their IPO, and once the IPO is done, then they have to list themselves on the stock exchange. So when a company is looking for fund in the market, when the company is looking for fund in the market, what the company can do, company can come up with SEBI, and the company can submit a document to the SEBI that is called draft offer document. The company can submit a draft offer document to the SEBI. By looking into the draft offer document, SEBI decides, okay, should we allow them to come up with an IPO or not. And once SEBI allowed them to come up with an IPO, then the company can come up with their IPO. And once the IPO of the company is done, so since through IPO the company has raised a fund from the market, and now the general public has bought the ownership of the company in the form of shares. So the the regulatory body regulation says that if a company has done the IPO, if they have taken money from the public and given them their ownership in the form of share, then the company within 7 to 10 days, the company has to list themselves on the stock exchanges. And then you'll find the company after the IPO, they get listed on the stock exchange. And once they listed on the stock exchange, you'll find them trading on the market. Okay, so like this. So if now I've given you the example of depositories like CDSL, NSDL. So you can see CDSL. CDSL, you can buy and sell the shares of CDSL. The price of CDSL share is 1336. You can see that CDSL share is 1336. You can buy its share, you can sell its share. So because CDSL is a public company, but if you see NSDL, you will not find NSDL because NSDL is not a public company. NSDL is a private company. So I hope you're getting what is private company, what is public company. So a private company, once they have done the IPO, they become a public company. Once they become a public company, you'll find them trading over the market. So I hope you have understood about this. So today's session, we have discussed about equity and debt, derivatives, mutual funds. I'll discuss in the next class. Okay, so the market where the company raise money, okay, that is called as primary market. Okay, so the IPO, after IPO, what is FPO, right issue, all this thing we'll discuss. All these things come under primary market. Okay, so remember this. Once the company has done the IPO and they have listed on the stock exchange, then you can do trading over them. That is called secondary market. So secondary market objective is capital appreciation. It includes the further trading of securities already offered to the public. So shares are offered to the public first time through IPO, okay, through the primary market. Once the IPO is done, the same company shares, you'll find them trading on the market. And because of the continuous buying and selling of the people, and a company or an investor, what they want capital appreciation. They want the value of money to appreciate in the market. And that happens because of the way the company behave in the market. So when the demand will be more than the supply, automatically the price of the share will go up, and that price of share going up, that lead to capital appreciation. Okay, so I hope you have understood. So this much we'll do in the present class. Okay, more in the next class we'll continue from here. So I hope you have understood what we have done in this class. So it's time to wind up the present class. Guys, I'll see you all in next class. Take care. Bye everyone. Thank you everyone.